Hello, everybody. A very good day to you, and welcome to the third episode in Rethink's mini podcast series, where we will hopefully help you navigate the sometimes choppy waters of UAE corporate tax legislation and equip you with the knowledge to have your business CT ready in advance of your next financial year. We hope you found the first two podcasts helpful. And my name is Neil Guthrie. I lead the finance and tax teams here at Rethink, and I'm very happy to say I'm joined once again by Kirti Vudamoody, who's our Director of Tax.
Hello, everyone.
So let's start this episode, like we do with every episode, by having a recap of what we covered in the last podcast. So what we covered was the areas of CT that we believe your business will be impacted by, and also the considerable preparatory work necessary before the start of your next financial year. And we drilled a bit down into the accounting and administration burden for all businesses regardless of size and complexity. Such things as financial reporting under IFRS or equivalent accounting, acceptable accounting principles to the UAE authorities. The stringent record and documentation keeping requirements, and the need to digitally transfer information to the tax authorities when they request it. So what did we learn? Well, hopefully, more than anything else, you'll learn that corporate tax will potentially impact almost all areas of your business. And we realize that's a big claim. So we will undertake to illustrate that with concrete examples in this podcast and also in future podcasts. We urged you also to start modeling and forecasting CT's impact and start looking at your strategic options. And please not to procrastinate. You don't have bags of time to prepare. In this episode, we're going to look at aspects of the law that are more applicable to medium and larger UAE companies, such as those in a group structure, those with business outside of the UAE. And we'll also look at how foreign companies can fall into the net for CT. But you have to note as well at this stage, the legislation is very detailed. It obviously has to be to cover all eventualities and situations. And we can only cover the concepts we discuss at a summary level in this podcast, but we will, of course, revisit them and explain in detail the legislation in future podcasts. So to start the journey into the murky waters of CT's complexity, it's important to understand what brings UAE businesses and foreign businesses into scope for UAE corporate tax. And to do this, we need to explore the concept of resident and non-resident taxable persons. So Kirti, could you explain to us what constitutes a resident and a non-resident person for a CT and what income they will be taxable upon?
Sure, Neil. Firstly, let's clear one thing. In tax parlance, a person can be either a juridical person, that is a legal person such as a company or a partnership, or a natural person, in other words, an individual human being. Of course, unless a natural person carries out a business or a business activity in the UAE, they are not in scope for corporate tax in any way whatsoever. But UAE companies, both UAE companies and foreign companies trading with or having presence in the UAE, especially larger corporations, really need to understand the definition of these terms and see the implications associated with them. If not, UAE registered businesses may not adequately manage their tax affairs to ensure they are receiving the maximum credit against UAE taxes for taxes paid in other jurisdiction on foreign earnings. And foreign registered entities may unwittingly fall into the net of UAE corporate taxation. Apart from a small number of exempt companies such as government entities, as we said in the previous podcast, all businesses carrying out business activities in the UAE fall in the scope of corporate taxation. This is both resident and non-resident persons. Now, coming to resident person, a resident taxable person is any legal person incorporated in the UAE, that is both mainland and free zone, or a legal person incorporated outside UAE, but effectively managed and controlled in the UAE, or a natural person who conducts business or business activity in the UAE. Now, coming to the taxable income of a resident person, any income derived in the UAE or income derived from outside UAE is subject to tax. So in simple terms, there are two major aspects to note here. Firstly, a resident business will be taxed on its worldwide income with allowance made for taxes paid in other countries. And secondly, foreign registered businesses will be treated as resident for UAE tax if they are effectively managed and controlled in the UAE. The definition of management and control is very involved, that in other jurisdictions where the provisions have been enforced for many years often has to be resolved by courts. A non-resident taxable person is a foreign legal entity with a PE in the UAE, or a foreign legal entity with no PE in the UAE but earning UAE sourced income, or a foreign legal entity with nexus in the UAE, and the word nexus is to be specified by a cabinet decision. And non-resident taxable person's taxable income is the income from all the above sources.
Okay, thanks, Kirti. That's very useful indeed. So turning to income that's exempt from CT, the law, of course, is very far-reaching, but there are certain types of income that are exempt, aren't there?
Yes, indeed. Dividends from UAE resident businesses are exempt from CT, no strings attached, but capital gains from UAE resident businesses will be subject to participation interest, will be eligible for an exemption. Net income of a foreign permanent establishment subject to tax in a foreign jurisdiction is exempt, but again subject to terms and conditions. Dividends and capital gains from a foreign shareholding will be exempt, subject to minimum shareholding of 5% and a minimum holding period, or intending to hold for a minimum of 12 months. UAE companies with a foreign branch can either claim foreign tax credit for the taxes paid in the other country in which the foreign branch is located, or elect to claim exemption for foreign branch profits. Again, this is subject to terms and conditions. As an example of how CT can impact the legal entity structure in a group, UAE companies with shareholding in foreign entities not meeting the participating interest, that is the minimum 5% or a minimum holding period of 12 months, may have to consider increasing their shareholding, so dividends and other passive income is exempt.
Well, that's great. So some relief there for businesses. And talking of relief, can a business get relief if it's making tax losses?
Yes, in fact, businesses can carry forward these losses and set off against the taxable income in any year, but a cap of 75% of the taxable income is what can be allowed as a set off.
Okay, thanks for that. And how about losses of one group company being set off against the profits or the taxable profits of another group company, like happens in many OECD countries?
Sure. A parent entity holding directly or indirectly at least 95% share capital and control of UAE subsidiaries can form a tax group with these UAE subsidiaries. Now, such tax grouped entities can offset tax losses by virtue of a consolidation. But there will definitely be entities which does not qualify this minimum 95% shareholding. Those entities, if they have direct or indirect common shareholding of 75%, can offset losses from one entity to against the taxable profits of the other entity, but a cap of 75% of the taxable income of the entity that is availing the relief can only be availed. The conditions for taxable transfer of tax losses, as well as the clawback of tax losses, is detailed, and we will cover that in a future podcast.
Okay, that's very clear. And we couldn't, of course, conclude a podcast on the CT aspects of larger companies without mentioning the thorny subject of transfer pricing, can we?
Indeed not. UAE is introducing a transfer pricing regime in line with the OECD principles. The transfer pricing is of a particular concern for group companies and requires all business transactions with related and connected parties to be at arm's length price. This includes both cross-border and domestic transactions. We will come back to TP in a dedicated future podcast, as this is an important issue with extensive regulation, including how to establish an arm's length price and documentation requirements. As an example of how TP could impact your business model in adjusting to commercial pricing, where a group mainland entity had been undercharging a free zone entity for goods or services it had been provided versus a commercial price, leading to only modest profits in the mainland entity. Adjusting to TP requirements could significantly increase the profits of the mainland entity and result in a large tax bill. In this case, it may make sense to go to procure the supply from elsewhere.
Thanks, Kirti. You're clearly tackling our big claim about CT impacting almost all aspects of business, tackling that head on with a couple of really good examples there, and we'll continue that theme in future podcasts. So, but I think that's probably enough for today. It's a lot to digest. And even though we haven't given full chapter and verse on all the concepts that we've been talking about, it's enough to bamboozle nonetheless. So, and if you are a little unclear, it's not really surprising, and you're certainly in good company, because there's a quote reliably attributed to Albert Einstein, which is, the hardest thing in the world to understand is income taxes. Well, harder to understand than the theory of relativity, I doubt. Certainly, we hope not, and we hope that that will not be the case if you watch our podcasts. Anyway, Kirti and I will be back next time, in 2 weeks' time, when we will talk about the CT implications for free zone entities. But in the meantime, we wish you a very good day, and we hope to see you in a fortnight's time.
Thank you, everyone.
Thank you.